No question. So thanks for doing this, Nick. Really appreciate this. And for everybody that's on the call, my name is Dan Galsace, and myself and Morgan Bland are co-hosting this, along with our guests, Nick Griffin, who's a partner and a portfolio manager for Monroe Partners, and also our Canadian or Monroe's Canadian institutional strategist, Akilin Karuna, who's also joining us on the call today. These guys are a phenomenal wealth of information for Morgan and myself, just to kind of round out our knowledge of the team, how they manage the portfolio with Monroe Partners, and just how they see the world. Quite a bit different from your traditional portfolio manager, in the sense that they really are providing access to areas that we often don't see with traditional PMs. The other thing I think that's unique, and most of you would agree, is that a lot of the reason why we have placed our trust with Nick and the team at Monroe Partners is just their long history of not only being able to generate solid returns over time, but also smoothing out those returns and providing superior risk-adjusted returns for their investors. And we were fortunate enough in 2018 to partner up with Monroe and have them introduce some product into North America. This is, I think we've raised somewhere in the neighborhood of $2 billion. I think the complete asset in Canada, Nick or Akilin, correct me if I'm wrong, we're probably about 2.5 billion in fund assets, and about another 250 or so on the ETF, which is the CMAG. A couple of things that kind of happened in the last little while as well with the Monroe Partners products is we've offered US dollar versions. So for those of you who have clients that are interested in having US dollar exposure, you can now own Monroe on the US dollar side, both in the mutual fund as well as the ETF. So that adds another element of opportunity for your clients. As you know, last year Monroe was the top performing liquid alternative in Canada. And we're proud to have them as partners, and we had a number of very happy clients. Year to date, obviously, has been a bit of a seesaw in terms of the markets as well as interest rates. And so we wanted to bring things kind of to perspective to all of our clients on the phone. All of you own Monroe Partners, and that's really the key that we wanted to do. We didn't want to open this up to the entire client base. We wanted to focus on those of you that already are familiarized with the product and with Monroe's process, but just to get an update from Nick and Akilin, and then kind of answer some key questions that you might have. We've got a few that were submitted in advance, so we'll get to those as well, but for the most part, we want to keep it an open forum. And the best way to get those questions in would be to type them in the chat. So as you're thinking of them, feel free to pop them in the chat. We'll pose them to Nick. And at this point, I'm going to turn it over to Nick to give us a sort of a 30,000-foot view of how he sees the markets, opportunities, et cetera. I'm just going to mute somebody here, or maybe Morgan, you can mute. There we go. All right. So Nick, with that little intro, I'll turn it over to you to kind of give us a background and where you see the world right now.
Yeah. So thanks very much, Dan, and thanks everyone for dialing in. Just a couple of things to remind people of, I suppose, before I'll talk about the State of the Union. So the one thing, obviously, to remind people of here, and hopefully you can see the screen, is at the end of the day, our job and everyone's job and how we've generated our returns for the last 15 years is really to focus on trying to find these very few winners in the equity market. So the reality is equity markets are made up of very few winners and lots of losers. If you invested in the product, you've seen me present this slide before. It just shows you the top 50 in the S&P over the last 90 years. They make up nearly 50% of the value. And so over time, it is that structural, and if you look at those companies over time, you can see them here. It's always the structural changes that create these big winners. That's essentially what we're trying to find. That's our job as your global growth manager. And obviously over that journey, there are lots of swings and roundabouts, et cetera, but as long as you stay focused on this prize, you will ultimately get the superior risk-adjusted returns you're looking for. And so our job really is to really occupy this top left-hand corner and identify these structural winners and identify how that they're going to win over a long period of time, and then take advantage of the compounding that those companies will create. And so from that point of view, that is our main goal. And the most important thing to flag here is that, look, I've never seen interest rates or inflation change who wins in the long run. They just change the price you pay for it. And so this concept of very few winners and lots of losers will remain. All that you're going through at the moment is this rotation around interest rates and inflation, because some of these companies got well ahead of themselves and they need to pull back, and that makes perfect sense to us. You can see that in our returns from last year. And some of these companies, you know, people are trying to play the cycle. It's literally been, it must have been 12 years since we've had a real cycle. We're now getting a cycle purely because we shut the world down and reopened it. So it's a bit like, you know, of course we're getting a cycle. What surprised us a little bit, I must confess, is how many people are buying into this. Because, you know, as much as I'm excited about, I can see the opportunity for oil and gas companies, and I can see the opportunity for banks, and I can see the valuation arbitrage for these companies. I'm just not convinced that you're going to want to own these things a year from now. Because once the recovery's happened, it's very hard to think about a world where growth's going to be significantly above where it was prior to the crisis. So this is the prize. Occupy the left-hand corner. Try and find these few winners. In terms of more recent performance, look, clearly this just shows how we use capital protection tools to deal with drawdowns. So obviously, as we said, you know, we've clearly had a strong period for a number of our tech holdings in particular. We have diversified that with other areas. I'll talk about that in a second. But we've had a strong period for our tech holdings. They are underperforming at the moment. So our long equities are going down to a certain extent, or have been since about mid-February. And we can offset that with short returns, put options, FX. It's important to remember that you know, this was the COVID correction. This is 2018. This is much more a 2018 style correction for us because it's really been driven by interest rates going up. And so the actual market's not going down. So a lot of these put options that work so well through COVID, they've worked okay here. We've added about 150 basis points, but they haven't really offset the fall in the equities, and hence funds had probably pushing close to 8 or 9% drawdown from its peak, while the market's not really drawing down. And I know that could be frustrating for people, but it's not uncommon for us if you go back to 2018 or you go back to 2016 or you go back to other periods. And so our job is to really try and minimize that drawdown as much as we can through this period, and then ultimately move towards and then take advantage of these opportunities. What we've generally done is the put options and the shorts have worked well through February. Most of those are closed now. And we've also raised some cash. So the fund's running about 20-25% cash at the moment. And we have not yet deployed that. And I'm happy to talk about why in Q&A. Last thing is just how we position the fund by our areas of interest. We did come into this year thinking we had this reasonably diversified. We had a portion of climate and high performance computing or semiconductors that would be our cyclical tailwind. But we were still very committed to our digital areas, and I'm happy to talk about why. In the end, the digital areas have underperformed through this period, which I think is understandable, particularly some of the smaller cap holdings, but we do have a mix of large and smaller cap holdings. But I think so. The thing that's obviously caught us out a little bit is the climate stocks were so strong after Biden got elected that they've also corrected at the same time. And even the semis have corrected a little bit. And it's really just because they had such a strong period of performance. And so January and February were very strong, but March has been a bit more difficult. But ultimately the fund is, you know, roughly flat for the year. And considering the carnage that is out there, quite frankly, and to give you an idea of the carnage, you know, someone's managed to blow up their entire hedge fund for $20 billion worth of assets while the market's at an all-time high, which I think is a really, really impressive effort from their behalf. And so from that point of view, there is obviously a lot going under the surface. And so considering that, you know, I'd probably take that. I mean, it's the capital losses that we care about the most. We haven't had any yet this year. And so that's, and, you know, the relative underperformance, you know, is, I suppose, somewhat understandable at this point in time. Long term, don't forget the prize. Do not forget the prize. This is the prize. This is the prize. This is the prize. You need to keep finding these long-term winners. As much as you'd love to be able to say, look, I'm just going to sell it and buy this company and then flip back again. It just doesn't work out that way. That's been our experience in a long period of time. And when you do sell it, you generally don't come back, and then you've missed out on that compounding that you're looking for, which is ultimately going to drive your returns in the long run. And so from that point of view, that's probably a good summary of where we are.
Perfect. Now you've obviously taken a bit off, given that you're net long about 70%, I think, right now. What areas would you have done that with? Where do you see some opportunities, and what's the timing on some of those opportunities? How soon do you expect to deploy some of those opportunities?
Yeah, so what you can see here, and this is a little bit out of date, but you can see roughly we were running exposure, very high through the back half of last year. So we were having net exposure around 80, but our gross was up at sort of 120. So we had shorts and longs that were working very well for a very long period of time. What we correctly identified was the shorts were going to get quite difficult, so we've closed most of them. So good news is didn't lose any money on shorts here. Then we also correctly identified that interest rates, which is our biggest red flag for the fund, started going up in February. So we basically raised 10% very quickly, and another 10% since then. So roughly 20% in cash. So we're running the fund, 65% net, 80% gross at the moment. Now there are some longs and shorts in there, so the actual best way to think about it is about 20% cash. And so we're running what we would call a more compact position, because it's very hard right now. You can buy something one day and then be down 8% on it the next. And it's sort of the washing machine. And so we've seen this before. The washing machine is going to continue, I suspect, for a little while longer. And the reason why is because of the backup in interest rates. So interest rates backing up at the speed they back up is our number one negative flag. So interest rates going up per se is not a bad thing, but interest rates backing up at the speed they're backing up is a bad thing. And so I'll give you an example here. This is actually the performance of the fund over the last 4 years in Australia, and the Canadian fund is less. But periods like we've been through before, would be this back half of 2018, where you sort of have this pause. You need to protect capital for a little while, and off you go. The other period would be December. It's very hard to see on the graph. It'll back up. It doesn't stop. Interest rates going up doesn't stop us making money. It's just this period of time as they back up quite quickly where you need to be a little bit careful. And you've obviously seen that going through the market. So from our point of view, I'd prefer to see the long bond at 2%. That would be a good indicator. Obviously, interest rates are going up for the right reasons, which is great. The economy is reopening, economic growth is coming back. None of this is particularly scary from a market point of view, I don't think, just yet. But there's a chance it could become scary if the bond market maybe became dislocated. And so from that point of view, we're just being prudent, quite frankly, and waiting for better opportunities. Where would we put the money to work? Look, it's a function of two things. I think the two areas we're most focused are, we're getting some really good opportunities in software here. So software's clearly hurt us a bit this year. But I just think there's some wonderful opportunities coming up here. Maybe closer to the second half of the year. But the funny story I will pass on to you is, Zoom has effectively fallen 50% from its peak. We've been back in the office now, as I said at the start, for 4 months here in Australia. So I have, everyone can come to the office. The problem is everyone doesn't come to the office. And so you move to this and see, there go my lights. You move to this sort of hybrid, structure. And so my Zoom bill has gone up fourfold because I was running Zoom at home for everybody at home. I now have to run Zoom in the office. I have to buy all the equipment. I have to buy the Zoom phone. So some people can be in a meeting room and some people can't be in a meeting room. Our expenditure on software is not going down because COVID's going away. It's actually going up. And so this concept that they're so-called work from home winners, I think is quite frankly laughable. DocuSign's another great example. You just got the entire world to move to digital signatures. They're not going to go back to the office and start printing this stuff out again. It's just not going to happen. So these companies are providing great opportunities. It's quite exciting. And look, the climate area in particular is one where we've probably evolving the holdings a little bit. It's because really this is when you think about the stimulus that's coming, and you're going to hear Biden talk about it this week, it's all going to go to climate. And so this is a combination of renewable energy companies, etc. But it's important to stress they have done quite well. So our Vestas and Orsteds and stuff, we've made more than 100% the last 12 months on some of these stocks. what you'll see us start to do is evolve that into much more vanilla companies that people don't otherwise realize are winners, like building materials around insulation, HVAC equipment, air conditioning. If you think about it, most companies in the world are going to have to replace their fuel oil heating system. Every school's going to have to replace its fuel oil heating system in favor of some sort of electric heat pump. Insulation is going to get a big uplift, and you're just going to see this huge renovation boom, particularly in Europe. And so there's actually quite a lot of companies in Europe that are, quite frankly, previously quite boring, that are probably going to become these big climate winners. And so that climate area you're going to see is going to get very diverse for us. Those are the main areas where we'd probably be putting cash to work. So a mixture of cyclical and the stuff that's sold off.
Excellent. As far as that climate and that cyclical side of your potential acquisition going forward, what kind of timeline would you see as far as those taking major effects? Like, obviously Europe is going through a massive kind of injection of capital into the climate change. How soon do you see that kind of impacting performance on those securities?
Yeah, so at the moment the market's just, and I'll just try and find the picture I'm after. So the beauty of the climate area is what we're really focused on is, so we showed you this about a year ago. $30 trillion expenditure. We've been working on this pretty much for 2 years now straight. And it just covers so many different companies and so many different areas of the market. And so decarbonization, as we know, is just going to cost so much money. And 30 trillion is, that's lowball. It's going to be like 50. And so this concept that it's only going to, benefit, Tesla, or it's only going to benefit solar and wind is, it's just not feasible. You can't actually fit that much money into those companies. And so the more we've looked at it, the more it's things like transmission grids, batteries, hydrogen. So there's a lot of sexy stuff here that's gone up a lot. And if anything, that's what I said at the start, a lot of that stuff went up more than we thought, and has basically and got us a little bit too correlated there as we came into this. But it's really this energy efficiency bucket and these transmission areas where there's just a lot of really boring companies that are going to win. And again, that's the area that you'd start to see it, and you'll start to see it come through for the European companies in the second half of this year. And then I think for the US companies the year after in 2022. And so just think about things like a grant to make your house more carbon friendly. That's what the French are doing. It's a $30,000 grant to put insulation in your house or to replace your fuel oil pump to a heat pump. Those are the sorts of things that are coming, a grant to install solar, etc. And so my point is, a lot of people have gone for the really obvious ones here, and we did too, and did well. It's now time to think about the less obvious, and I just think there's lots of them, and so we're really quite excited about it, because this should be and will be the biggest area in our fund for quite some time.
Perfect. Another question that comes up from time to time is semiconductor space. You mentioned that that's actually tailed off a little bit of late. There seems to be a lot of issues now around that space. What's your take on how things are going now, and our valuations looking a little better than they were in the past?
So semis, just because they went up, they went up too much. So TSMC, we made 100% on last year. We still like it a lot, but just got profit taking. ASML's still been very good for us. I don't think anything's here really changed. I think this is still a wonderful opportunity, and if anything, it's really just price action, very short term. The news flow is still very strong, and so when we look at semiconductors, we talk about the extension of Moore's law, we talk about the companies that can win, but if you think about this brewing sandstorm, it is still continuing, and if anything, it's getting worse. And so you're getting the strong growth in semiconductor market size. The Internet of Things is growing dramatically, as is the industrial side of it, as is the cloud side of it. And so this is a genuine opportunity here. And so what you've seen since we looked at this is everything that just confirms our investment cases. So you've got shortages in semiconductors around autos globally. You've got Intel saying they want to get back into the foundry business by building onshore foundries in the US. TSMC is going to build onshore foundries in the US as well. And then you've also got an economic recovery. And so this massively favors TSMC. It massively favors ASML on the equipment side. It massively favors Micron in memory, and it massively favors NVIDIA and Broadcom. They're the 5 companies we own. They've all done very well, so I can understand the profit taking, but the investment thesis hasn't changed at all. And in many cases, still some good valuation support on these companies. So while we might change the number of stocks, the holdings that we have here, so some may go and we'll replace them with other ones. This is going to be a core part of our portfolio for a while.
And moving kind of onto the e-commerce side, a couple of times I've seen presented both by you and James, an example of the valuation of Amazon and why it remains attractive today. I don't know if you're prepared to kind of show that at this stage. It was a pretty good chart. If you have it available, love to see it, or just speak to it.
Yeah. Okay. I'll show you 2 things. So let me just talk about maybe something from today. So when we look at e-commerce, and so this comes back to really what I said at the start, is what you're paying us to do is to find these areas of interest and find these structural winners. If we can find them, they drive our returns. The big obvious one in the world today is e-commerce. E-commerce is basically, this is US retail sales over time. This is total e-commerce in the US. And so what you're seeing is e-commerce share go from effectively nothing to 20% pre the crisis, and then there's big acceleration through the crisis that we think probably sticks. And so the funny one, I'm actually going to talk about something slightly different, and then I'll come back to Amazon, if that makes sense. And so the one we really like at the moment is actually HelloFresh. So HelloFresh, if you think about e-commerce, if you think about, this chart before here, ultimately over time, it's actually different categories that are getting disrupted. So you started with toys and office equipment, then you moved to clothing, then you moved to furniture. So everybody on this call has bought, toys online. They've bought sporting equipment online. A couple of years ago, they started buying clothes online, but remember, it took a little bit while to get used to it. And then, now you're actually buying furniture online, right? So you're just getting more used to it. And why are you doing it? Because it's more convenient. You're not doing it because it's cheaper. You're doing it because it's more convenient. Groceries is the big one to go. 3% is online today, yet it's the largest TAM in the world. It's $1 trillion in the US and $4 trillion globally. So this sets up like an Amazon opportunity all over again. Because you basically got to disrupt this. Now, Amazon's trying to do this, but we would argue the one we like the most is actually HelloFresh. HelloFresh, for those of you who don't know, is a subscription meal box. You probably tried it during COVID because you were scared of going to the supermarket, or it was too hard to go to the supermarket. It's now a $4 billion revenue company. It's 10 times the size of its nearest competitor. And so it's a big meal box delivery company. But what everyone's missing is it's just another way of ordering your groceries. And so if you think about HelloFresh versus groceries, there's just a huge opportunity for them to go for here, like a huge opportunity. And then from our point of view, we see them with, nearly 60% market share in North America, completely trounced the competition. It's Amazon all over again. They've built all the infrastructure. The infrastructure means the product gets delivered well. You get a good result from the product. That creates good network effects, and round and round you go. And so once you get used to this box arriving at your house, you get used to the box arriving. What else could you add to the box? And so this company is number 1 in 14 countries around the world in this product, in probably the biggest area of e-commerce that's going to be disrupted. Okay, so coming back to maybe, and I'll bring this back to the Amazon story or the HelloFresh story. Here's the really funny thing, right? The stock trades on 30 times earnings. Okay, it's dirt cheap. It's on like 20 times EBITDA. And I can sit on the phone to every single analyst in Europe, and they'll all tell me as soon as COVID goes away, everyone's going to switch HelloFresh off. And I can sit here and say to them until I'm blue in the face, I live in Australia. There is no COVID. No one's turned it off. Everyone's turning it on. I've got the website data to prove that HelloFresh's growth in January is still up 60% from what it was in October, and which is up 60% from what it was in May. So I know that no one's going to turn this thing off. But I cannot convince anybody that this is the case, because I live in the Southern Hemisphere and everyone's in the Northern Hemisphere, and they're just absolutely convinced that this reopening is going to mean everything that was this way is this way. And so I sort of, my pet hate for the moment is the reopening trade versus the work from home trade. It's just laughable, quite frankly, that these things aren't going to stick. And so from that point of view, that's just providing a wonderful opportunity. And in this case, it's very, very cheap. And so the point is it reminds you, I suppose, and this is where you're looking for the Amazon trick, but then our job really is to find these companies, and sorry, I'll just take the Bloomberg away, and to run them for long periods of time. And we really like this one. This is a genuine 5 to 10 times your money opportunity. Okay. Sure, I can't convince people now, but the earnings growth will drive the stock price. Ultimately, the earnings will go up. The stock will follow its earnings. That's what will happen. And it reminds us, like if we go back to Amazon, and I'm just using my Bloomberg here, so apologies. But, we've owned Amazon for 7 years. In fact, longer than that, 8 years. It was the other e-commerce winner before HelloFresh. And so hopefully this doesn't slow the Zoom down.
That's
what I'm showing you here is, okay, let's go to the last 7 years. This is Amazon's EBITDA back in 2014, $7 billion of EBITDA. And today it makes $75 billion in EBITDA. So we're going to use EBITDA because it's cash flow. Yeah. That's how Amazon runs their show. Their market cap has gone from 150 billion to 1.5 trillion. So their EBITDA has gone up 10 times and their market cap's gone up 10 times, okay? The stock has followed its earnings, okay? But it doesn't follow the straight line, okay? So they've delivered on a straight line, but the share price does not. And so you have these re-ratings and de-ratings and re-ratings and de-ratings all along the way. To show the same chart another way, this is the EBITDA, EV to EBITDA of Amazon over the same 7 years. And so what you can see is it's obviously traded at roughly the same multiple the whole way. Now, it's got as high as 26. It's got as low as 16. It's got as high as 26. It's about halfway at the moment. It could get lower. It could go back up again. But it's generally held this area. Now, my model tells me very clearly that Amazon's EBITDA is going to double again from here. It's going to get to 150 billion. It's very hard for that not to happen, purely because of their position in the cloud and purely because of their position in e-commerce. And so the EBITDA will double again. And so either the EBITDA multiple is going to drop back to 16 and I'm only going to make 60% of my money, or it's going to stay the same and I'm going to make 100% of my money, or it's going to go back to 26 and I'm going to make 125% of my money. And so from our point of view, the maths around that is incredibly simple. And so I would just remind people that, every time these derating episodes happen, it makes you want to, like, this was the Fed tightening too much. This is Donald Trump getting elected. All these things come along. This is inflation coming back, etc. All these things come along to try and convince you to go away from the stock. But what you need to remember is, what does the math say? And the math says that this is a great risk-adjusted return from here. And we could sell it here and try and buy it back here if we wanted to. But for all the times you do that, you're actually going to miss out on that wonderful compounding opportunity. And that's what we're trying to do every day, which is why we're keeping our Amazon, but it's also why we really like HelloFresh here.
On that note, the HelloFresh question, the fact that you just went through that, we did get a question on that regarding their moat and how much protection the business has from competition.
Yeah, so it's a great question. And so it is important to remember that obviously all of these ideas, when you're buying a company for 11 billion euros and you think it can go to 100, it's not without risk. In this case, the risk is more than so priced into it. We would expect competition to come along. So far, they've actually managed to destroy most of their competition. So Blue Apron, in the same way Amazon destroyed most of their competition, the network effects have meant they've beat them. So Marley Spoon, Blue Apron. There's lots of little ones coming along. To be honest, the competition right now is actually good because it imitates them. Anything that imitates them is a win, because HelloFresh's biggest risk is not the competition. The biggest risk is people can't get their head around a box of food being delivered to the door as a way of shopping for their groceries. And the reason why we like it so much is because COVID solved that problem for them. So we found this company years ago and loved it, but, the customer acquisition costs were too high. COVID solved that. Customer acquisition costs collapsed. It's now a highly profitable company. And so the flywheel, the network effects are now moving for them, and we can't see why it would stop. But yes, there are clearly risks along the way, but so far they look manageable. The guys seem to have it under control, but it's also in the price. It's a very cheap company for what it is.
Perfect. I did get a couple of questions on individual positions. Feel free to just give a quick answer to these. The first one is Shopify, and I know you've mentioned this before in the past, and Twilio is the second one. Thoughts?
Okay, so we love them both. We don't own Shopify. Would love to see it come back a bit more. We've always struggled with Shopify because it's the sort of best, it's the most exciting company in Canada, I suppose, and so it generally runs at a multiple higher than what you could buy things in the US, for instance. But in concept, love the business. Twilio we also like and we do own. We have reduced the position. So when you talked about, and sorry, I didn't answer your question before, but when you talked about where we cut the 20% from, we cut the 20% from, we cut some of these high multiple positions that we like a lot, but so if you think about our digital enterprise bucket, which let's assume that's the problem at the moment, it's 15% of the fund. 6 holdings is actually now 5. Microsoft is still the biggest position, but Atlassian and Twilio, which is still there, we halve them both. And as much as it's getting close to buying them back yet, we're probably not topping them up yet. In the long run, Twilio and Atlassian are winners here, and not just little winners, like really big winners. So that would be, and they're really big winners because we can't see how they're not going to be a really important part of the software stack in the long run. Twilio in particular looks fascinating because it's actually hard to see how there's a single consumer business in the world that will not become a Twilio subscriber. And so Twilio has over 250,000 customers today. Atlassian has over 200,000 customers today. There's a really good chance that goes well through 1 million for both of them. They're charging virtually nothing for the product, so there's a pricing tailwind as well. And so, if you wanted to take a 10-year view and buy them here, I'd highly encourage you to do that. If you're worried about the next 3 months, then you might get a better opportunity.
Exactly.
The other ones that we would put in that category where you're going to get a really good opportunity here are Zoom. This concept that Zoom's going to go away it's a joke. September, you really want to be thinking about buying Zoom. And the other one that's clearly part of the ecosystem now and will be for a very long time is Square. And so those would be the ones that we'd be getting, as they come back, quite excited about here.
Okay, awesome. And back to e-commerce, or just on e-commerce, do you think it can work in the luxury goods space? I did get a ticker, Farfetch. Does that ever come up on your? Yeah.
We've looked at it. We prefer to play it from the luxury goods players. So the actual easy way to play it, if you think about Nike's been incredibly successful with this direct-to-consumer relationship via e-commerce. So think about the way they drop Air Jordans, and they put them on their site, and so they effectively circumvent you from going around to a shop to get your Air Jordans to going to Nike. And once they get you at Nike, they can keep you as a consumer and they can cultivate you. That makes Nike one of the best omni-channel retailers in the world. And that's why the company does so well, despite the fact that there's sporting equipment everywhere, right? There's lots of different compares, but Nike keeps winning. So the big opportunity is actually here for companies like Louis Vuitton, companies like Moncler, companies like Kering who own Gucci, because their e-commerce sales at the moment are sub 10%, and they should be 50. And so their ability to improve them, to not have to build these amazing $6 million stores that they build to sell their product, they'll still need them, but they can get all these extra sales by cultivating loyalty, doing capsule drops of very high-end products. Farfetch is effectively a reseller of online, and I get it. It's just a slightly riskier way of doing it. We'd prefer to buy the luxury goods companies themselves.
The questions are coming in fast and furious. I got another one back to kind of on the grocery side of things again. Being a low margin business, can they maintain these low margins while adding the delivery and packaging costs?
It is amazing. Okay, so check this out. I was blown away. HelloFresh makes a 68% gross margin on a food box. That's like up there with some of the software companies we look at.
Yeah.
And the reason why they do it, and sorry, I'll just try and find my pictures again. The reason, I've lost it. This is what happens when I shrink it. Bear with me.
No
The
worries.
reason why they make a 68% gross margin is because of this stuff, right? So it's the food wastage, right? So they're, and I don't have the picture here, but the great opportunity that HelloFresh has is it really is a huge sustainability champion. So previously food goes from, farmer to warehouse to supermarket to you, and there's probably even a distributor in between. And the same pallet gets taken from this size to this size to this size to this side and into your bag. HelloFresh gets the food delivered straight to the warehouse. And if you've ever got the box, you open it and there's like one sweet potato there, or three potatoes or three tomatoes. So there's just no food wastage. And so from that point of view, because there's no food wastage, the actual box is a very high margin product, like very high margin, because they're selling that box you're looking at here for roughly $60. It's got 3 meals in it. And so for you, the consumer, it's equivalent to you going to buying to the supermarket and doing it yourself, just without the wastage. It's more convenient for you because you don't need to think about what you're going to cook for the week. If you ask, and like, Peter Lynch says, always ask your wife. My wife loves this product because she's like, I just don't have to think about it.
Yeah.
It just arrives. And I encourage you to ask as many people as you can. My even more favorite thing, massive aside here, is, you want to get your kids to eat nice food. They come downstairs and they look and they go, oh no, it's Moroccan chicken. And you go, sorry kids, that's just what arrived in the box. I can't change that. So it's a 68% gross margin product. And the rest of it, they spend on sales and marketing and delivery. So the margins for the company are actually 10%, which is double the supermarket margin today. And that's while they're growing at, 100% last year. So I think their margins can actually go to 20%. And so this is just a classic Amazon,
Right.
Cut a whole bunch of loops out of the chain, pass that value onto the consumer, grow your product, and then your margins will come later.
Perfect. I got a couple others here. As far as the EV space having run up like crazy, what are your thoughts on Tesla and any competitors that you would look at?
Okay, so Tesla's the only one that we would buy. And we don't own it at the moment. So we have owned it in the past, and that's one of the ones that we raise cash on. I would avoid the whole place like the plague at the moment. I just think it's that classic scenario where, and again, as I said at the start, everyone went for the obvious ones. They all went up a lot. They've priced in a lot. Even Volkswagen and GM and Ford have gone up now. So one thing I do know is we're still only going to sell 90 million cars 10 years from now. They may all be electric. They can't possibly all win. And so Tesla's the one you want to own, and maybe let it come in a bit more. But the rest of them, just avoid like the plague. It's going to end in tears.
As an aside, did you see, just off topic here, a boat that was, I think it was launched in the last couple of days, like an e-boat or a electric boat? Did you see that?
Yeah, I didn't.
$300,000.
I didn't, but there's e-planes coming at some point. Yeah. The problem with electric cars is it's starting to feel like electric scooters. I must have seen about 20 different versions of an electric scooter cruising past the road around me, trying to win the electric scooter race, and it just feels like cars are going to go the same way. Customer service and whoever's got the most money wins, and that's Tesla. So I still think they win in the long run, but this is a bit like what the market is right now. So a lot of people, no one's asked is the market in a bubble. The great news about what's happened in the last 3 months is you are getting and the Fed must be rapt about this. You're getting this deflation of all this speculation. It is all these little bubbles are popping, a bit like when the marijuana bubble popped in Canada. You're getting these little bubbles pop throughout the market without the market going down, which is just great. I mean, in terms of a pause to refresh to set us up for the next leg higher, it's just fantastic. Now, that's not a done deal that we're going to get through this as rates back up. I'm sure there's going to be more blow-ups along the way. But the longer this goes on, the better it sets us up for the future, because you're going to take a lot of the speculation out without actually damaging the market, which is great news.
Perfect. And so I'll throw you a few more, and then I'm going to throw you a question that might come out of left field here. But right out of the gate, as far as crypto, what are your thoughts on crypto? Obviously, Tesla access through Elon Musk, they picked up quite a bit. I think there was an announcement with PayPal and crypto. Give us your thoughts on that. NFTs, anything like that come to mind?
Yeah, so from our point of view, this is a very exciting area. You know, and to give you an idea of why it's so exciting is, you know, you're basically moving to a point where cash is about to disappear altogether. So once cash disappears altogether, some pretty funky things are going to happen. The biggest opportunity is really for the fintechs. You know, they used to operate in, you know, e-commerce or peer-to-peer financing, all of these different areas, and you're starting to see all these other areas that they're opening can move into, things like, as you said, NFTs, move into things like payday lending. They can issue their own credit cards, things like Cash App at Square, the PayPal app. You know, they're suddenly doing all these things. They're effectively turning into super apps. And so that opens up this stuff, you know, the offline store retail, the cross-border payments, the domestic non-cash payments, you know, paying your bills, etc. And so the other way to think about this is, if you think about the top revenue of the top fintechs in the world, it's about $100 billion. The revenue of the top 30 banks in the world is about 1.5 trillion. All the fintechs are going to do is just slowly eat away at this margin for the next 20 years. Banks only exist because of physical legacies. So, you know, TD Bank, Toronto Dominion Bank, is in Toronto, right? You know, Bank of Montreal's in Montreal. Bank of Queensland's in Queensland. That's where your branch network was. That's where you raise cash, and then you grew off that. Once everything goes digital, there's just no reason to have all these banks. There's just no point for them all to exist. Network effects will slowly drag more and more people to these apps, and these apps will do more and more things for you. And so you basically, you know, think about Google wiping out newspapers. It's going to be exactly the same. The fintechs are going to wipe out all these regional banks around the world very slowly, very slowly. It won't happen quickly. And obviously regulation and stuff will try and slow that down along the way. Crypto is just an important part of this. So crypto is the last extension of the whole thing, which is, if you don't need banks and you don't want regional banks, then why do you need regional currencies? It doesn't actually make a ton of sense. You know, another way to take out cost would to be have a digital currency that, you know, when I'm in Canada, I can pay with my digital currency. When you're in Australia, you can pay. And so all of this extra cost of doing FX exchanges, and we've all had bad experiences, goes away. So there's really obvious reasons for all of these things to exist. I would say PayPal sits at the center of all this. So PayPal's the one we like, but I mentioned Square also. They're your sort of two horsemen here. They're the guys who are going to sit at the middle of this and basically use crypto or use seller services or use e-commerce as a way of attracting people to their ecosystem. And once they've got you in their ecosystem, they will start selling all these other things to you: buy now, pay later, Venmo, you name it, payday lending. And so crypto is just one part of the investment case for PayPal and Square. If you want to invest in crypto yourself, I can completely understand why. Just remember, it's going to be quite volatile, but you know, there's an argument to have it as a portion of your holdings. But if you want companies that are listed, which is what we do, they're the two you want to focus on. PayPal's the one we like the most at the moment, just because it's cheaper, and Square's going to come back a bit. But given the opportunity, we would do Square as well if we could get the risk reward the way we wanted it.
A couple more questions here. One's on infrastructure. With huge global infrastructure spends coming, would you ever buy a company producing iron ore for steel? Or is Australia being shut out of China now due to politics, which I think can be happening in a lot of places? So that's kind of a two-part question.
So the answer is yes, we would. We've done commodities before. We would do them again. Iron ore does look quite good here, to be honest, as does copper. Even oil in the short term looks okay, but long term not. We would come back to this. This is where the stimulus is going to go. This is, if you really want to focus the stimulus, you know, then, and I'd come back to, so Joe Biden's going to announce this stimulus package this week, right? Everyone's going to get really excited again. It's probably going to cause more rotation again. He's not going to get it all through. Okay, Donald Trump announced the same thing when he started. You know, the bridges and roads never got built. The bridges and roads won't get built this time either. But what will happen is they will change the regulations. So they'll change the EPA Act. They'll change the building regulations. These are all things that they can do without the Senate. Okay, you can put your own people in charge of all these departments, and you can change things. You've seen it in Canada with the Keystone Pipeline, etc. So these are the things you can do like that. And so from our point of view, we prefer building materials at the moment, in particular, because they're double winners. We prefer industrials around clean air. We prefer electric utilities and transmission grids. That's the stimulus stuff that we're looking at, because we agree it's definitely going to happen, and Europe's going to do the same thing. And if anything, the ones in Europe look better, because people have just given Europe no chance of growing ever again. And if they spend all this money, then it's going to be virtually impossible for them not to.
And the second part of that question was Australia. I guess that's more of a geopolitical question with Australia.
Yeah. So look, I think it's one of the biggest risks in the world right now is, so you would have heard me say, we've reduced our China exposure significantly, and that's one of the things we did get right, because it's been bad. But the day the Ant IPO got pulled, we cut our Alibaba in half. We've reduced our Tencent. I was super excited about China being a great place to invest once the Biden administration came in, and the exact reverse has happened. And this is just hugely disappointing, because it was a wonderful opportunity for this to happen, and the Chinese have chosen not to take it, which I think is frustrating and highly unpredictable. And so from that point of view, China exposure is very low. It's a wonderful opportunity in the long run, but the way they're behaving to Canada and the US is the way they've been behaving to us now for 12 months. Right. And I think it's ill-advised, but that's what they're doing. And we'll see where it turns out. But from our point of view, we've definitely backed off.
So there's a comment here now. I didn't know this. Maybe you can enlighten us on this. Were you at one point an oil and gas analyst, A? And B, to that, where do you see WTI prices in the next 1, 3, 5, or 10 years?
So yes, I was an oil and gas analyst. And maybe the long story there is just to remember that technology solves most things. So when I was an oil and gas analyst, it was peak oil, right? It was going to $150, and Suncor was digging it out of the ground. Shale came along and solved the problem, and so it was just a fascinating time to be covering the sector. But that was 15 years ago now. I was an oil and gas analyst. I have not looked at the sector at all until about 2 years ago, where we started to short it, and we did quite well shorting it. We covered those shorts well, and I can completely see why it squeezes here. So I think the oil price could squeeze higher in a 1 year view. On a 3 year view, it's probably back where it is now, and on a 5 year view, it's definitely down.
Okay, that's great.
And the reason why is because of exactly what there in Canada, right? This is a limited resource, and your job now is to get it out as fast as you can. The Saudis know that, the Americans know that, and the Canadians know that. The problem in Canada is because of your political situation, you can't get it out. And because of your landlocked situation, which I think is a disaster, because may as well monetize the asset while you can, because if you don't do it, everyone else is going to do it. But in the long run, we're not going to be using as much oil as we do today. Yep. And so that's why in the long run, the price can't really hold up from my point of view.
Okay, there's probably only time for a few more questions. I got one here in the chat we haven't answered, and it was back to that, the digital cash. Digital payments, I should say. I know you own MasterCard. I don't know if you still own it, but the question was, can Visa and MasterCard stay relevant given all the other competition that we're speaking of?
Yes, yes, they can in the medium term. In the long run, maybe not, but don't underestimate how much more runway there is still to go with just tap and go, cash to card. Quite frankly, I mean, you've got whole countries that still run on cash, like Greece and Italy, and even the United States still runs significantly on cash. So most of the US hasn't even been issued their tap and go cards yet. So there's this long runway of growth still ahead for those companies, and they're definitely trying to position themselves for all these things. And don't forget, crypto could work on Visa as well. They're very good at doing this. No, it's the banks that are the problem. The banks are just going to lose. All their high earnings revenue streams are basically slowly getting taken away from them. And that's and I just don't know how they stop that from happening. And then you just got to work out who that's going to go to. And just remember that fintechs are a bit like Facebook or Google or things. Network effects means there'll only be a couple. There can't be 600 like there is today. That's not going to work out. And so the couple we think look best positioned are PayPal and Square.
Perfect. So just two more questions. One is, given if the inflationary environment were somewhat extended, how would you execute some of your hedges? That's the final kind of official question. I've got one to follow up from that.
Yeah, so it's a good question. So in terms of the hedging, ultimately, we need the thing that definitely has come true through this and come back to this, and so the internal conversation. And again, this is not uncommon for us, but potentially a broader portfolio was probably required entering the year than what we had. So we felt like we had the cyclical component and the inflationary components covered with semiconductors and climate. Probably hasn't worked out as well as we would have liked. So from that point of view, I'm not saying it's worked out badly. I'm just saying we could have done better here. We definitely could have done a lot worse. You only have to look around to see some people who've gone a lot worse. But we can always do better. From our point of view, it's the broadening. All that you're seeing here is exactly what you saw in 2016. You've got a new president. He's spending a lot of money. You're getting a broadening of growth ideas in the world. And so the market is pulling down the premium for growth on some stocks and adding that premium to other stocks. And that's just a broadening. And so I think there's definitely an argument that we could broaden our portfolio with more luxury goods, for instance. We do own aerospace and Ryanair. And definitely in that climate area, we could broaden our portfolio slightly. So I think there's an argument for that. That would counter some of these inflation risks, because inflation's ultimately good for equities. I mean, it's good for equities in the long run. Because they can benefit from it. Last thing I'd just say is, once the adjustment's done here, this concept that software is going to be worse off just because it's really expensive is not true. If inflation comes along and growth comes along, people spend more money on IT. They spend more money on software. You can push through price rises. So once the adjustment's over, the equity market should broaden in its rally. And so rising inflation itself shouldn't actually be that big an issue for us over the medium term. Last thing is look, the hedging tools will work. If inflation got so bad that the Fed had to hike rates and to cut, then the whole market's got a problem, not just our portfolio.
Yeah.
And that's when the hedging tools will kick in. But if inflation never got that bad, trust me, the whole world's got a really, really big problem, because everybody is relying on one thing, and we're relying on this as well, is that most countries in the world, I'll let you know a newsflash, can't afford interest rates over 2.5%. Okay, so if rates get above 2.5%, everyone's got a problem. Our portfolio has a problem, but everyone has a problem. And so inflation got to the point that the Fed had to do that, then that's a particularly bad scenario, and our hedging tools will be required in a really big way, but they'll be all around market hedges.
Okay, fantastic. There's only one other question in there. The rest we'll try to get to later. I'll pass them on to Killen. But Nick, in closing, for our advisor partners, how would you position this mandate in an easy elevator pitch for their clients? You got
30 seconds. So we want to be your global growth manager. Okay, so you've got bond funds, you've got value funds, you've got Canadian equities. We want to be your global growth manager. We are a piece of the puzzle that you are putting together for your clients. And ultimately, what we want us to be able to say is, you can buy CMAG today, and you wake up tomorrow and you'll own Taiwanese semiconductor foundries, you'll own Danish wind turbine manufacturers, and you'll own US software companies. You'll get access to some of the best growth companies in the world. And stocks follow earnings in the long run. There can only be a few winners, and our job is to go find it. So the simple elevator pitch is, we want to be your global growth manager, and you will need one, because these companies are going to come along and try to disintermediate other parts of your portfolio, and so they provide balance in what you're trying to do.
Perfect. Okay. Last question. AC/DC or Midnight Oil?
Midnight Oil.
Okay. Well, we'll wrap it up there. Thanks a lot, Nick. Really.
Hey, Midnight Oil did a concert the other day.
Oh, did they? I was going to ask you. That's incredible.
They're back playing. Yeah, they played a winery the other day, and a lot of my friends went.
That's outstanding.
But they still ordered their HelloFresh boxes. So don't get sucked into the reopening versus the work from home stuff. It's not how it's going to work out.
Yeah. Nick, that was excellent. I really appreciate it. And certainly, hopefully everybody on the call, certainly appreciate you joining us. We'll make sure to send you the replay, and also for any questions we didn't get to, I know there's a few, we'll make sure that we find an answer and share it with you. So thanks again. Thanks, Nick. Thanks, Akilin. And thanks, Morgan, and everybody on the call. Appreciate it.
Thanks, Dan. Speak to you soon. Take care. Bye-bye.
Talk to you soon.